let's look at exercise 9. So exercise 9, this runs into page 975, I think. Yeah, 974 to 975. And here we're going to look at computing the change in cash and identifying non-cash transactions. Okay, so it says Judy's makeup shop earned net income of $22,000, which included depreciation of $16,000, and she acquired a building by borrowing $119,000 on a long-term note payable. So they want to know, how much did Judy's cash balance increase or decrease during the year? So we want to know how much cash she had. Well, when we're looking at this, she started with net income, right? So let's look at her net income was $22,000. And when we're doing the operating section, remember we would add back any non-cash expenses. So we're going to add back depreciation, which was $16,000. And that's going to get us our total increase in cash, because those are the only two things that they gave us. So she had a net increase in cash. Whoops. Where did that net income come from? That's $22,000. Of $38,000. Okay. Then they asked, well, were there any non-cash transactions? If so, show how they would be reported on the statement of cash flow. Well, on the statement of cash flow, non-cash transactions are going to be either listed at the bottom of the statement, okay, in the non-cash investing and financing activities section, or in a separate footnote in the financial statements. So here, since she acquired a building by borrowing money on a note, that is a non-cash transaction because no cash was involved. So the purchase of the building with a note payable is our non-cash transaction, okay? And like I said, it's going to be reported at the bottom of the statement of cash flows statement in a separate statement called non-cash investing and financing activities section, or in a separate note to the financial statements, okay?